Good afternoon. Welcome to the weekly livestock market update. I'm your host, Meghan Grebner, with us as always to talk all things markets. University of Missouri, Scott Brown. Good afternoon, Scott.
Good afternoon, Megan.
Our program is brought to you by the Feed Stuff Finder from the University of Missouri. Feed Stuff Finder was developed by the University of Missouri Extension with funds provided by the North Central Extension Risk Management Education Center and the USDA's National Institute of Food and Agriculture. You can find a link in our newsletter, which will come out tomorrow morning. We're going to talk everything today. We're going to talk some cold storage. We'll talk some prospective plantings, a little quarterly hogs and pigs. We'll talk a little demand as we take a look at restaurant performance index. But to kick things off, let's recap what happened this week in the markets.
Yeah, Megan, on the cattle side this week, we had live fed cattle that were down $1.40. Those feeder cattle auctions were down $6 to $9 this week. We also saw futures down. The April live cattle futures contract closed down for the week, $2.40. And the April feeder contract was down $4.70. Choice box beef price was also lower this week, down $3.80. On the hog side, cash barrels and gilts were 85 cents higher this week. And the April live lean hog futures contract was up $2.15. We also saw a higher pork cutout value this week, up $2.10.
So I will start out by saying we have been moving higher, pretty much on a solid move up on the cattle side of things. We saw markets pull back pretty significantly at midweek. Some might call that suspect because we've had that conversation about highly pathogenic avian influenza showing up in the dairy cattle herd. I guess the question that we have to ask first is it speculation? Is it just concern? Or is it just markets are going to do this because markets are going to do what they're going to do?
Well, so I'll certainly say we're at lofty levels, Megan. When you think about fed cattle prices for the week of March 22nd, we were right at $1.90 for live prices. That's records. That's record levels. I always say when we're at this level, more downside risk than upside potential. Markets will get jumpy to the news of the day. So I'm not sure that we can identify exactly anything that caused the move down. I will say a shortened slaughter week could be at play as well in terms of what we're doing. Everybody knows this is an Easter weekend and we're going to be down on slaughter. Again, we're in pretty tough territory when you look at just all of the uncertainty at the potential reductions in slaughter coming, as well as just how high we are in prices today.
I think that brings up the risk management point, and I don't know if I need to beat a dead horse to hit that nail on the head again. But I think as you have conversations, and we have conversations with producers, knowing that we're seeing this constant push higher right now, and knowing that there are tighter supplies coming, we'd have to think that some risk management conversations should be happening regularly.
Yes, I say all the time, things like LRP have to be a part of the mix. And I will say for me, I look back at what was happening in 2014, late 2014 through 2016. Let's take feeder cattle here for a minute. So 6 to 7 weight Oklahoma City prices started that period at about $2.75. And by the time we got through most of 2016, they were back below $1.30. I want to protect against that risk. I remember a lot of discussion about we thought cattle prices were going to stay higher longer, and they didn't. So I think protecting against the downside's a good idea. Having said that, I still think we have opportunities for higher prices ahead. Just how much risk are you willing to take, and how much do you want to lay off with some of the products that are out there? I will say all the time, I tell producers, I want you to pay that LRP premium and not get an indemnity payment. And don't call me when that happens, because that meant cattle prices went higher. So we're not trying to maximize, we're only trying to reduce risk. Now, if you don't need to worry about that downside risk as a cattle producer. You have plenty of funds to withstand lower prices. I think that depends on the operation. So I will just keep saying, though, we have tools available for risk management in cattle markets that we haven't had in the past. And using those tools to eliminate some downside, even if it just makes you sleep better at night, I think is often what people will say. Maybe is enough for you to decide you want to jump off and do some LRP. The last thing I'll say, I still hear a lot of people who will say things like LRP are too complicated for me. And I will kind of bite back against that. And I'll say LRP is fairly straightforward. Find your insurance agent who wants to sell you LRP. They will walk you through all of those decisions, and it will be very straightforward. You don't have to worry about futures markets. There are no margin calls. You don't have to pay the premium until the contract's done. There's so many good things about these products that I think producers should think about.
All right, let's talk weekly slaughter numbers. You mentioned a lighter slaughter week as we things are moving today and everything except futures are open, but we're just running at a slower and reduced pace.
Yeah, that's right. So USDA is telling us for the week ending March 30th, a run of 586,000 head of cattle this week. That is 12,000 less than what we did last week and 59,000 head less than what we did 1 year ago. Also on the hog side, a run of 2.404 million head, according to USDA. That's 128,000 head less than last week and 80,000 head less than 1 year ago.
As we take a look at those year to date, compared to where we were a year ago, let's talk a little bit about the cattle numbers and the hog numbers.
Yeah, so if we look at cattle slaughter year to date, down 5.8%. I'll remind us we're going to get still a little bit of move in these percentages as we go, but down pretty hard, while hog slaughter year to date up 0.5%.
All right, let's get into these reports. We'll start with cold storage. As we take a look at ending stocks for beef and pork, how are things compared to where we were a year ago?
So tight is the really what we got out of cold storage. I'd sometimes like to start when you look at overall meat protein supplies, lowest levels we've seen in several years. Beef ending stocks about 440 million pounds at the end of February. That compares to what was about 500 million pounds in 2023. So down 60 million pounds on the beef side. Pork's also lower. A little less than 460 million pounds of pork in freezers at the end of February this year. That compares to about 520 million pounds in 2023 at the same time. So it is certainly low inventory. When you look at pork in particular, lowest February we've seen in more than 20 years so that's maybe some good news from a demand standpoint in that these stocks continue to tighten.
When we talk about that demand element, how I guess I'm impressed, surprised that knowing kind of the turbulent economy we've gone through in the last couple of years, this is not something that consumers are necessarily stopping from putting in their grocery baskets.
It sure seems, despite in some cases like beef of very high prices, that I think demand is staying with us fairly well. Now, I always say I don't like to read too much into these ending stock numbers because we produce a heck of a lot more during the month than what would have been the drawdown in stocks relative to the previous year. But it still points to what is a tightening situation. And I think demand has been fairly good in total when you look at what's been happening in all of these meat proteins. Even chicken, who is down almost 70 million pounds. We were just down across the board in all meat proteins.
Let's talk Prospective plantings. I was trying to decide if I wanted to switch and stick with the demand and go into restaurant performance and then pair prospective plantings and hogs and pigs together. Let's do chronologically. We'll start with prospective plantings.
Yeah, so I know, and you and I have talked a little bit about maybe opportunities for locking in some cheaper feed costs, but prospective plantings that we got out yesterday, USDA told us 90 million acres of corn to be planted this spring. That is down about 5% from what we saw last year, below the pre-report midpoint of 92 million acres. So corn markets did respond to that yesterday. Last I knew, they were up about 15 cents. I don't know if they ended yesterday there or not, but certainly maybe some higher feed costs. On the soybean side, 86.5 million acres of soybeans, according to USDA. That is up about 3% from last year. We'll see. Again, this is what folks expected in early March. That's when that survey would have gone out. We'll see what kind of changes we get between now and when the June acreage report comes out.
Do you put a lot of stock in the prospective plantings report when you think about the reports that we come out in terms of acreage between this compared to the one that comes out in June, and then when we get the final numbers later in the year?
So I probably like June over what we see here. And again, for me, the difference is you've got producers trying to answer the question in early March about what are they going to plant. There's a lot of things that can happen between that early March survey time and when they actually get crops in the ground. So I think June gives us a better read of that. Do I think the general tone of the report is correct of less corn, more soybeans? Absolutely. And I don't want to quibble over whether it was 90 or 92 million acres of corn, too much at this point. But I guess I expect a little more corn than what we got in prospective plantings, but I'm not going to second guess USDA's estimate here.
Restaurant performance numbers out this week as well. Talk to me about how we're doing in the first quarter compared to how we ended 2023.
Yeah, so I think the important part, if you look back at November, we were starting to talk about an overall index greater than 100, so a little bit of expansion, and we had come through a number of years starting in 2021 where we were talking about expansion, right? So 100 and above expansion, 100 or less contraction. We have been coming down ever since 2021. First quarter here, if you look again for what we saw in February, an overall index of 99, up 0.3% from where we were in January, but still talking about contraction. Same store sales still were down about 1.3%. Customer traffic, although up, down 3.1 points. So for me, that tells a little bit of both sides. So perhaps we're finding consumers trying to somewhat scale back, just given the high costs that they're seeing. I don't want to read too much into where we're at. We go back into the worst of 2008, 2009. We had indices that were in the 96 range. So we're just sitting here at 99 today. So we're not back in that bad period of time of demand.
All right. Quarterly hogs and pigs out yesterday afternoon. As you and I talked last week, kind of what's going on in terms of breeding inventory, what's going on in terms of pigs per litter. Some surprises, some really, I think, larger surprises. And then let's get into what this means for the rest of 2024 and into 2025.
Yeah, so I think this report has a little bit for everybody. That's going to be the way I start this. When you look at kept for breeding, the pre-report estimates would have had a midpoint of down 3% relative to where it was a year ago. The report actually came in down 2.1%, so a little less than that midpoint average. Yet when you look at how many sows did we farrow December through February, the pre-report estimates would have had an average of 98.2 of a year ago. The report came in at 97.4. So farrowing seemed to be down. Intentions, all right, so March through May intentions actually came in a little stronger than the pre-report estimate by a little more than a percentage point. But June through August was right on track, down roughly 2%. The other piece of this that we've been talking about for a while is pigs per litter. Pre-report said we would be up on be 103.3% of a year ago. It came in at 104.6 according to the report. So lose breeding inventory, gain pigs per litter, pig crop, USDA told us up 101.9. So when you and I talk about higher hog slaughter this year, I think you start to see that it's the productivity gains that are outweighing what's a loss of breeding inventory and giving us more hogs as we deal with 2024. But there's pluses on and minuses on both sides of this. So it's an interesting report for sure.
When we talk about the production efficiency today, obviously we've talked about this before we get into this, right? Like we're culling sows that aren't as productive. We're streamlining business. But when we think about what we need, it's so different in the hog industry, right? Thinking about contraction or how things trigger because we have become so efficient in production. What is that? How does that set producers up for risk management in terms of like long-term risk management, thinking at the end of this year into 2025 and beyond?
Well, so I had somebody recently ask me if the hog cycle was dead. And I think my response to that is the hog cycle's different today. So in the old days, we would talk about years where we'd have increased production and years with decreased production. Well, now we're in this situation where we get years of increased production followed by flat. And that's the best we can get in terms of the down cycle, because as we get rid of those least productive sows, pigs per litter goes up, and it makes it that much harder to get production to turn lower. And I think that is important from a longer term risk management perspective. Now, I will say I think the industry lost enough equity in 2023 that we may be flatter for a longer period of time. So we may have lengthened what's going to be kind of this sideways that we keep talking about. But I do think one wants to think about the opportunities. Now, I think this gets hard from a risk management standpoint, because I say all the time, I think demand, especially for hogs at the farm level, is very unresponsive to price, very inelastic. So you just get a little bit of shift of supplies backwards, and all of a sudden you can go from very low prices to very high prices. More volatility. We often have been, I think, attributing volatility to black swan events. And I'll say volatility because we're changing the structure of what demand looks like for those hogs. And I think that's one of the important pieces long term for producers to think about. And I guess my last point is, when you think about cost of production distribution today, 25 years ago, we might have had a really wide distribution. And what have we done is we've gotten rid of producers over time. We've narrowed. So now this competition for the most efficient production is a much tougher fight. And some who thought they might have had the upper hand are learning that the competition is a lot more fierce today than it was 20 years ago.
So in terms of thinking about this long term, because things have changed and because it's different than some of the other proteins, is flat our best expectations in terms of not growing demand exponentially, but also does risk management, does market development in other countries play a bigger role in risk management for US pork producers today than it ever has?
So I think diversifying your demand options is certainly a good risk management strategy. And when you look at not not putting all your eggs, how's that for the Easter, all your eggs in the China basket, which is, I think the pork industry has done a wonderful job of Mexico, other Central American countries, growing those markets. That is risk management, and I think it is important. And we need to really be focused on international demand strength as we look ahead. I think that's the opportunity for us to be producing more pork in the years ahead.
Plenty for us to talk about as we continue to move through 2024.
There's no lack of things to talk about, Megan.
How fortuitous. Next week we have jobs. We also have monthly trade data. As you look ahead specifically on the trade side of things, what do you watch for? What are the keys for you there?
Yeah, so I think strength in pork exports is going to be important as we think about where prices go here in 2024 on the pork side of the equation. On beef in particular, so I'm watching imports. I think they're going to be up again, and then just how much do we see quantity of beef exports down? I think from a value basis we'll be okay, but all of a sudden those two things help us offset what will be less beef production here in the United States in 2024.
Scott, great to see you. Happy second opening day, day next to opening day.
I wore my Royal shirt while I could early on. I'm not sure that I can be seen in it after a little while, but I hope I'm wrong, and this is a year that they could make the playoffs.
Well, good luck to you. We will check in with you next Friday.
Take care, Megan.
So for weekly livestock market update delivered to your email box every Saturday morning, go to brownfieldagnews.com. You can also submit questions and comments. And for a rundown of what happened in the markets and a preview, make sure to check out John Perkins' Market Minute. Have a great weekend. Happy Easter. I'm Meghan Grebner for Brownfield.